While making mistakes is in our human nature, it's extremely painful when those mistakes are related with our money. Hello guys, my name is Mehmet Kara, and today I'm gonna talk about the top 7 mistakes you could do with your investments. And be aware that this video is for beginner investors and not for those of you who don't have any investment at all. Because living from paycheck to paycheck is the biggest mistake you could do, and everyone who wants to be financially independent knows that you should save part of your money and invest it. But still, if you are investing, there are a few mistakes that you could do and they could ruin your investment plans. So this is why I will review those mistakes with you, and make sure to stick till the end of this video in order to know how to avoid them. Although it might seem easy, save part of your money, invest them, get great returns, and let the compound interest do the rest, it's still not that easy, because the financial system is like a floor designed with landmines buried in the ground that could blow up your financial future. In this video we are gonna talk about the top 7 mistakes, and if you don't see them coming, if you're not aware of them, they will systematically destroy your financial future. So go to a quiet place, grab your pen, grab a sheet of paper, and let us reveal the top 7 mistakes that you could do. Well, this is a very common mistake. Successful market timing is extremely difficult, and even institutional investors fail to do it often. Why is market timing a bad idea? Let us show us the S&P 500 index in this crazy year 2020. At the beginning of the year it was a little bit above the 3000 level, and if you would sell your S&P 500 index right when the crisis began in March, you would have a loss of several hundreds of dollars. On the other hand, if you wouldn't sell your shares and you would stick with them and hold them, you will be still with profit this year. So you can see how much bad market timing can hurt your investments. And this is a proven truth that no one can predict the market. Before I go on to the next mistake, let me quote my favorite investor, Ray Dalio, who says that trying to predict the market is like playing poker with the best players of the world who play around the clock with literally unlimited resources. Well, you might think this is not a common mistake, but actually there are $13 trillion which are actively managed in mutual funds with 265 million account holders. So why is investing in a mutual fund a big mistake? Let us hear it from Tony Robbins himself, because he describes it best.
Then the old adage is a person with money meets a person with experience, the person with experience ends up with your money. I mean, that's how it works. So I'll give you 2 or 3 of the myths real fast. One, this myth that someone says, give me your money and I'm gonna beat the market. It's just a lie. Warren Buffett made it clear it's a lie. Ray Dalio, one of the greatest investors in history. David Swensen, who has taken Yale's money, $1 billion, and converted it to $24 billion in 2 decades, the greatest institutional investor in the world. They've all said it. Warren Buffett flat out said today, he said, listen, in my will, 90% of my money, all that money does not go with any mutual fund, it goes straight into the index. What the index is you get a piece of all the largest companies in the world, but it costs almost nothing to get in. Because over any 10-year period of time, 96% of mutual funds will not even match the market. Now you're paying for a mutual fund. What this means is you hire someone because you say, I have a family, I have a business, I have a life. I'm not an investor. I'm gonna hire someone who's a professional. It makes sense they would do better than me. Unfortunately, that's wrong, because what happens is 4% of them will beat the market, but it's not the same 4%. Mm-hmm. So your chances of finding the right one, have you ever played blackjack?
Yes.
So if you play blackjack, everybody knows you play for 21. If you go above 21, you're gone. If you get 2 face cards and they're sitting in front of you and you got a 20 out of 21, and you got the chance to stay or say hit me, If you hit you, there's only one card that'll get you to you. It's an ace. If your inner idiot says, hit me, you have an 8% chance of winning. You have a 4% chance of finding the right mutual fund. It's not going to happen. So what happens for people is they think they've been sold, we're going to do better, and they might for a year or two. But what matters, you live off the long term. You don't live off the year or two, and they just don't do it. Warren Buffett has a bet right now with Protege Partners, which is a group that does hedge funds, and he said, you can pick 5 hedge funds. You can mold the best of them together. I'm gonna own the market, which costs me next to nothing. You're gonna get the hedge funds, which cost a lot. 10-year bet, who's gonna win? Put up $1 million. Right now, they're 6 years into it. Warren Buffett's at 42%, they're at 12%, right? Just crazy. So the second thing is, after getting terrible performance, people say, well, fees don't really matter, or they'll tell you it's only 1%. And I ask people all the time, how much are you paying? And they go, I don't know, or they'll say 1%. 1% is called the expense ratio. That's like the edge of the sticker price. If you read that 50-page prospectus in your mutual fund, even one of them has 50 pages, which you won't, you'd have a hard time with a PhD figuring it out. In fact, there's a man named Hilton Smith, I quote in the book, who spent 2 weeks, he's got a doctorate as an economist, took him 2 weeks to go through them all and figure out there are 17 different fees. And Forbes says the average fee is 3.12. Now, if you're watching right now, I'm sure I've lost your brain with all these numbers, so let me make it real for you. 1% versus 3%, big difference.
Huge.
Right? Here's the difference. Just like you grow by compounding like Theodore Johnson did, your fees also compound. And people don't know that when they hear that little number. So if you had 3 people and one gets 1% in fees, 2%, the other in 3%, they all get the same return. They start out with $100,000 at 35. For 30 years, they accumulate to 65 years old, 7% compounded. They all get 7%. The only difference is the fees. And when they go to retire, the person at 1% in fees is gonna have $574,000. $100,000 to $574, not a bad, if they added not another dime, pretty amazing. The person at 3% in fees will have $224,000. 77% less money. If you want to win a race and you have a 100-pound jockey on the back of your horse, or you want a 300-pound jockey on the back of your horse, fees at 3% are that. If I said to you, here's a deal, let's do an investment, and here's how I want it to work. You give me the money, you put up all the money, you put up all the risk, I'll put up no money, I'll put up no risk. If you lose, I win, and if you win, I win. And if you win, over the life of the time, I'll get 60% of what you earn. You'd say, I'll never do that in a million years. That's a mutual fund with 3%.
Turnover, or too much shifting from one position to another, is another killer that could kill your earnings. Unless you are an institutional investor who benefits from low taxes and from low commissions, I don't recommend you shifting too much your positions, because the commissions could eat your earnings. We could call this ignorance or failing to diversify. If you focus just on your domestic market and you invest only there, it doesn't matter if you live in UK or in the US, you do a huge mistake, because you miss on lots of opportunities that the world's economy is offering us. So this is why I would recommend you focusing on world index funds, like the Vanguard All World Index is a very good example. I think everyone is falling in love in the last days with Tesla, but this is a very common mistake. Before that it was Apple, Google, Amazon and so on. Don't forget that you bought the shares of this company as an investment, and it will be a huge mistake sticking with this company because you fall in love and not letting it go when you have to sell the shares. You could be blown away if you see how your trading style changes when you trade funds that you cannot afford losing. This is one of the biggest mistakes, investing money that you cannot afford losing. Because when you are obsessed with your emotions, you cannot take the best decisions of investing. There is an old Japanese proverb that says that you will lose eventually every money that you use for gambling. You should never put yourself in this high pressure situation where you put money that you cannot afford losing or you could use for other reasons. When you invest with money that you can afford losing, you will make much more relaxed decisions. Generally, you will have much more success with your trades when you are relaxed and when you're calm. and not driven by fear or some other negative emotions. So this is the top one mistake, not understanding the business. Why is this important? We are often driven by some hot investments, like for example Bitcoin or something else that we are not aware of this, or biotech or something else. But remember that if you understand the business, for example, you have a restaurant business, you'll be much more aware with the restaurant franchise than the other investors. So this gives you a built-in advantage in front of all of the other investors. By extension, you will know if the industry is booming, getting in slowdown, or heading to a recession in front of all of the other investors. So this is why it's very important understanding the business before you invest in. And remember that those mistakes that I mentioned are just the top 7. There are lots of other mistakes you could do or other risks that you could take, like for example reading the news from bad resources, or being impatient, or for example doing too little due diligence. There are lots of mistakes, but how can you avoid them? Let's get to the point. To avoid committing those mistakes, you should develop a thoughtful and systematic plan and stick to it whenever and whatever happens. If you want to go something wild, you should take some money as a fun money, but be aware that you could risk and lose all of those money. Following those guidelines, you'll be well on the way on preparing your portfolio that will bring you joyful returns in the future. So you have done your first step. You are aware of those mistakes and you know how can you avoid them. So follow the rules and you will be a winner at the end of the day. Thank you guys for watching. Let me know what you think about this video in the comments below, and see you again next week with my next video.